This is our Forex blog for August 3rd, 2011. Our internet went down at 12 and it just came back up about 20 minutes later, so there will be some bars possibly delayed on these charts. Like most days, we really want to buy the strong pairs versus the weak. The Australian, again, was pretty much weak the majority of the night. CAD was weak at times, and its weekly and monthly trend were down. The Swiss weekly and monthly trend were up, and it was strong until about 3, and you can see the weakness was extremely weak until about 6, and then it starts to show some strength coming back in. Because the longer term trend was strong, it's pretty safe to assume you'll get an hour to 3 hours of strength. In this case, you had an hour, another 40 minutes of weakness, and then 2.5 hours of strength. That's why it's always best and easiest to trade in the direction of the longer term trend. We have real-time momentum, daily, weekly, and monthly underneath it. So if the weekly and monthly are super strong in this case, weak in the CAD's case, strong in the yen's case, weak in the euro's case, when this got weak here at 9, it's pretty safe to assume you might have an hour or two of weakness. It only lasted an hour, then had just very mild weakness. But anyway, starting the day off, we have extreme strength in the yen. Longer term, much stronger than the dollar, and at 1 here it became really strong. So you'd want to trade that against some of the weaker ones, the Australian or the CAD, weak on all time frames. Not in the New Zealand, or I'm sorry, the Australian is much weaker than the CAD. So the highest probability trade was looking for Australian yen sells starting the day off. This one had sold off all day, and you got a nice little rally up here. There's about a 35 pip drop here, 20 pip drop, and the market kind of chopped around and then went sideways. What I like to do now is illustrate our new range bars. Bring in Australian yen. You might want to look at a 6 pip per bar. Instead of a tick chart, which changes to a new bar every time there's X number of ticks, this one changes to a new bar after the price has moved X number of pips. You only make or lose money based on price movement. So bring this up on the chart. It has to download all the tick data. Because I lost internet access, I don't have to reboot eSignal. It's possible. I'm going to try to start up a new version of the software, and I'll just test it on a regular chart first. Okay. Alright, so it should work now. I lost connection to the internet. Now, this is a 6 pip per bar range bar, and it's very interesting. There's a lot of different patterns that you can use. In other words, after a pullback, this is a very weak currency. You can wait for a little rectangle pattern and sell the breakdown of it. Notice just absolutely collapses here. This one does not sell off right here. It continues up again. One of the other patterns that works really well is drawing a trend line underneath the lows, and when the trend line gets broken, you go short. Short at 83.10. If you did the same exact thing to get out of your trade, you'd probably exit this at 87 here. You made 20 pips, and you can see the market kind of retrace back up. You might be a little bit more cautious and wait for that, and it fell another 20 pips. But by waiting for either rectangle patterns or trend line breaks, you can catch very decent trades in a very weak Australian and strong yen. Now keep in mind the yen was only strong until about 3, and from that point on there was about an hour of strength and weakness, hour of strength and weakness. It wasn't like it was on some days where it's super strong or super weak all day. The same thing with the Australian. You can see from 3 to 4 it was relatively strong. That strength at 3 or 4:30 here started to subside. At 4:30, unfortunately, the yen is still very weak, but soon afterwards became strong again. So coming up to 5 was a pretty high probability place to look for sells, because the Australian was very weak. It had a strength for about an hour, and you can see the yen's weakness and the Australian strength made this go up. You also can draw your fibs on here. And anytime a currency is weak, usually at the fib target, it's a pretty high probability place to go short. You can go short here with a 10 pip stop. And usually after a currency goes up and then goes up another wave, it's likely to have two-wave pullback coming up to 5. You know, here's your first wave, and you know, maybe here's your second wave. You were short somewhere around 30 to 35. If you're a really aggressive trader, you might have sold this right here at the 37 once it hit twice. So you either made, you know, 47 pips or, you know, more than 30 at least, while risking 10. You had 3 times bigger, you know, win versus your risk. That's the real key to trading. A lot of these currencies were kind of choppy today. The pound was extremely strong. Its weekly and monthly trend is stronger than the euro, and you might have traded that against the much weaker dollar than the yen. You can see the dollar's monthly trend was down, and weekly trend shifted down, and daily trend down at 5. So 5, the pound dollar, very high probability buy. If you look at the 5-minute chart, you can see coming up to 5, this thing just kept exploding and then it went sideways. But let's look at a 6 pip range bar of this. Notice price is above the hourly at 3. When price goes above the hourly, it's much more likely to go up. When price is underneath the hourly, it's more likely to go down. Bringing up it on a range bar here, which you can put our containment bands on, which will show you the other time frames moving average. Let's do that real quick just to showcase that. Containment bands are based on longer time frame moving averages and maximum volatility over the past 20 days for that time frame. I usually like to put on the 1.5 and 2.2. Rarely does price go above the 3.0. We'll put that on as well. The green band, when it gets above or below the green band, you can usually look for counter trend trades. As you can see here, it pulled back, you know, about 30 pips from that level. When this broke above the hourly earlier today, you know, oftentimes when the hourly acts as resistance, once it breaks above it, it acts as support. Very high probability trade right here. It only went up from 85 to 01. It went up 15 pips. But, you know, it gives you a little bit clearer picture. And obviously, range bars, if the price gaps, you know, between the bar or inside the bar, if it's only moved up 2 pips and then gaps up 30, we're going to draw the bar all the way up to the high. But the next price print after this was all the way up here. You know, at that point, you know, you want to wait for a 3-bar pullback or for, you know, this breakout here. And usually the price is not going to go above the fib target. So this, again, the 3.0 band, maximum profit, Fibonacci profit targets there. If you had bought this breakout either right here at 70, you have a 30 pip profit, or if you bought the first pullback after that explosive move, you're in here around 60, you have a 40 pip profit. Now once a currency, you know, again goes above the upper band here, you know, especially when it double tops right here, you can go short with a very tight 7 or 8 pip stop, you know, and when it's kind of going sideways, you might move your stop down above the sideways range, or if it goes sideways long enough, you might sell the breakdown of this, you know, rectangle pattern, and this one didn't, you know, lead to too much profit, or you might have even broke even on that. Or if you really believe the price was going to reverse because it's up too much, once it makes a move down and comes up, you can yank your stop down above here, and usually that keeps you into the move if it's really going to continue down. You can see it made another wave down. Fib targets usually are, especially when markets are really strong, where the price goes to. You can see it came just within a pip of the fib target of that first wave down, and then it reversed. You know, after getting a 2-wave pullback, currencies that are this strong usually do reverse, so you can draw your trend lines off of here and get back in. And, you know, same exact thing that happened on the short. Your initial stop's underneath here. When it goes up, you yank your stop underneath the sideways rectangle, and you can use trend lines to get yourself out as well. This trade somewhere up here at 10 and around 65 for a very nice 45 pip profit.